Owners pay based on property value and local tax rules. Schools, roads, fire services, and sanitation may depend on it. Tax connects ownership to community costs. The pressure is visible when schools, roads, fire services, and sanitation may depend on it. The first detail worth separating is assessment estimates value. Local authorities estimate taxable value, not always market price. Concrete case. A home sells for one amount but is assessed differently. Property taxes are usually based on assessed value and a local tax rate used to fund public services. Tax rate applies to value. The bill usually combines assessed value with a local rate. Example: a higher rate can make a cheaper home cost more annually. Price alone is not enough. Ignoring this can hurt because the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. A reassessment may follow sale or market changes. Picture: a buyer budgets old taxes and faces a higher bill later. Check future tax estimates. In practice, review assessment rules, exemptions, reassessment timing, local rates, and appeal deadlines. That situation shows why assessed value, local budgets, tax rates, exemptions, and escrow deserve attention before anyone chooses a response. Some owners qualify for homestead, senior, veteran, or other relief. Daily version. Two neighbors can pay different taxes on similar homes. Here, a mortgage payment rises because the tax escrow changed shows why assessed value, local budgets, tax rates, exemptions, and escrow matter more than a surface description. The numbers have to be tested against the specific property, location, financing, and time horizon. Escrow changes payment timing. Many mortgage borrowers pay tax monthly into escrow. Monthly payment includes more than loan. The numbers have to be tested against the specific property, location, financing, and time horizon. The assessed value is not always the same as the market price, which is why appeals and local rules matter. If taxes rise, escrow payments may increase. Seen when a homeowner gets a higher monthly payment after escrow analysis. Tax changes affect cash flow. The situation shows the mechanism clearly. A mortgage payment rising because the tax escrow changed. Appeals can challenge value. Owners may dispute assessments with evidence. Daily version. Recent lower sales can support an appeal. This scene should leave one concrete lesson: assessment notices and local budget changes. In practice, recent lower sales can support an appeal. Improvements can raise taxes. Renovations may increase assessed value. Adding a room can improve life and raise the bill. Upgrades have tax consequences. The danger grows when adding a room can improve life and raise the bill. Location changes tax burden. Neighboring areas can have different rates and services. Real case. A home across a boundary may cost more each year. The numbers have to be tested against the specific property, location, financing, and time horizon. The detail turns uncertainty into a smaller question. Investors include property taxes when calculating yield. A rental that looks profitable before tax may become weak once annual tax, insurance, repairs, vacancy, and management costs are included. Two houses with the same rent can produce very different returns if one sits in a higher tax area. Property tax is not a side detail for investors, it is part of the real cost of owning the asset. Buyers should read tax history sets up the whole situation. Past increases reveal local patterns. Real case. A city funding new schools may raise future bills. Skipping this point matters because the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. Delay can turn a manageable choice into a more expensive one. In everyday terms, assessed value matters when it changes what someone spends, avoids, accepts, delays, or repeats. Tax liens are serious. Unpaid property taxes can create legal claims against the home. Think of ignoring bills can threaten ownership. Tax obligations come before many debts. Overlooking this creates trouble because the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. The difference between local rates and tax exemptions can explain why two similar situations lead to different outcomes. New developments may have special assessments. Some areas charge extra for infrastructure or community improvements. Version. A new subdivision may include additional district fees. Read all local charges. The numbers have to be tested against the specific property, location, financing, and time horizon. The topic becomes real when school budgets affects the next choice, bill, conversation, or risk. A lender may approve less if taxes are high. Same mortgage amount can have different monthly payments. Housing cost includes tax. Leaving this out is costly because the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. Noticing it in time makes the practical choice easier. The first clue is renters feel it indirectly. In practice, rising taxes can pressure rental prices. Ownership costs can pass through. This becomes expensive when the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. A mortgage payment rising because the tax escrow change becomes a decision instead of a guess. Property taxes can surprise owners because the bill is connected to public budgets and assessments, not only to the mortgage contract. Property tax is not fixed forever. Seen when planning for increases avoids payment shock. Leave room in housing budget. This becomes stressful when the mortgage may be affordable at purchase, but tax changes can reshape the long-term cost of owning. The moving part is simple. Property taxes use assessed value and local tax rates to fund public services through recurring bills. Two owners with similar houses may pay different amounts if exemptions, assessment caps, or local rates differ. Property taxes follow ownership, not just purchase price. A house can be affordable on closing day and still become heavier if assessments or tax rates rise. Buyers should check the tax history, local rules, and likely reassessment before assuming the monthly cost will stay fixed. A higher assessment can raise the monthly escrow even when the loan itself has not changed. Property taxes connect a home's assessed value to the cost of local services such as schools, roads, sanitation, parks, and emergency response. The bill can rise because the assessment changes, the local rate changes, or an exemption no longer applies. Property taxes are not random extra bills. They are usually built from assessed value, local tax rates, exemptions, and government budgets. The risk becomes real when a mortgage payment rises because the tax escrow change. Property tax turns local budgets into an ownership cost. That is why a buyer should ask how the tax bill may change after the sale closes. A buyer should ask how reassessment, exemptions, and local rates could change the cost after the sale. That is why a home can become more expensive to own even after the mortgage is set. The property may rise in assessed value, the rate may change, or exemptions may disappear. In practical terms, property taxes convert assessed value and tax rates into local government revenue, so the safest reading comes from the actual behavior, numbers, documents, or choices in front of you. Assessed value, exemptions, tax rates, and public spending decide the bill, which is why owning a home can become more expensive even when the mortgage payment stays fixed. For homeowners with escrow, that increase can show up as a higher monthly mortgage payment even when the loan rate is fixed.